Fed Chair Jerome Powell quieting expectations for a March rate cut on Wednesday, saying he doesn't expect the FOMC to reach, in his words, a level of confidence in the path of inflation by then. That's prompted investors to look to May, with more than 60% pricing in the first rate cut then, according to the CME FedWatch tool. For more on how to position your portfolio ahead of that, let's bring in Hetts, Janus Henderson, Investors Global Head of Multi-Assets. Good to talk to you today. Let's start with what we heard from the Fed chair yesterday, because this issue of him saying we don't feel quite confident just yet in beginning those rate cuts. As you see it, what are the key risks to reacceleration of inflation that you think could really shift the narrative?
Good question. It's a busy week, plenty to talk about today, including the comments from Chair Powell. So I think the risk here, it's not so much about reaccelerating in a sense, it's a very least sticky, I think, is a good base case expectation if investors are going to kind of plan for the best, plan for the worst and hope for the best. I think planning for the worst is maybe reacceleration or at least sticky, but I think this is a really healthy reminder this week for investors that we are dealing with the long and variable lags, that infamous impact of all these interest rate hikes we've just lived through. So I think this is a reminder that going through this year, we're likely going to have a lot of hot and cold, kind of stop and go economic readings and commentary spread throughout from Chair Powell and others. And so for portfolios, it means staying invested, but I think being a bit cautious and being defensive and being very active as we navigate all the hot and cold stop and go readings.
And Adam, Rochelle here. So then if you're the Fed and you're seeing, continuing to see strong economic data showing, the market, the economy really can deal with this holding pattern right now, what is the incentive to cut?
The incentive to cut, I think it's a reasonable premise for investors to think there's going to be cuts this year. Maybe not March, that might have been a little bit optimistic. The bigger question to us is what kind of cuts are we going to get? Because to your point, well, what is the motivation to cut? So to us, there's these chain reactions of those high interest rates transmitting through the economy, and that's going to result in cuts in one way or the other. So one cut could be this immaculate disinflation kind of adjustment cut, which is all is clear, 5.5% is relatively restrictive. It's historically restrictive in nominal and real terms. So that's one type of cut to say that's too restrictive. Things are moving along, they're slowing down on their own. That immaculate disinflation, that's great. The other cut is that recessionary cut. Maybe those chain reactions of these restrictive rates filtering through the economy and then create a recessionary spiral. And then that's the motivation for the cuts. And we're not out of the woods yet. And I think for all the talk about soft landing, I think Q4, the word hard landing totally fell out of the equation. And that to me was a little premature. And I think going into this year, we've seen a reversal of that Q4 broadening. And that's that healthy reminder that we're likely still somewhere between soft and hard landing, and investors should be positioned accordingly.
So what does that positioning look like? We're not necessarily taking a rate cut off the table, even if the timeline's been pushed back, but you're saying that risk between a soft and hard landing still exists. So how do you put together that portfolio?
And how to thread that needle, because if I'm talking about a soft landing, immaculate disinflation on one side, and then the hard landing, recessionary cuts on the other side, those are polar opposite outcomes. And you can't position portfolios on one extreme bed or the other, at least not sustainably, and certainly not for medium or long-term investors. So our view, it's still staying invested, erring on the side of caution. I think there's not just one elephant in the room, there's two big elephants trying to squeeze into the room. So one of which is Magnificent Seven and the historical amount of concentration we have. That's running about 30% of the S&P 500. The top seven should be more like 20% historically. And it's not just the US. Thinking globally now, that Magnificent Seven tech concentration, that's making portfolios historically concentrated in the US compared to the rest of the world. The US is about 70% of global developed equities as measured by the MSCI World Index. Just 30 years ago, the US was more like 30%. So we've got a historical concentration within the US. We've got a historical concentration in the US on a global stage. So that's one elephant in the room that investors need to navigate on the equity side of their portfolios. And the implication to your question is broadening outside the Magnificent Seven. So to us, that's embracing what there is to love in the Magnificent Seven, and there's a lot. There's strong earnings, there's quality, stable earnings, there's the AI exposure, there's interest rate sensitivity in a good way in this environment. But you can also find those aspects in parts of the other 493. But just be careful, because as you broaden out, you get more value oriented, you get more cyclical. So be very selective. As you go way down in cap to small cap, 40% of those are unprofitable. That's also a historically high number. So be active, be selective, look for that quality growth as you're going down in cap in equities and going international as well. That same playbook applies. So that's one elephant in the room. That's the concentration within equities. That other elephant squeezed into the room is these historically high cash balances in portfolios. And investors were seeing the most anticipated recession ever coming, supposedly, a year ago, and investors sold out of some equities and went to cash. You underperformed by 20% last year if you went from the S&P to cash last year. And that is really challenging, and investors are still holding on to those cash balances, and that feeds into the fixed income, or the 40 of the 60-40. And how do you work out of those cash balances and extend duration in fixed income portfolios?
So then, Adam, with that in mind, then, when do you expect to see a real sentiment change? I'm looking at the Bank of America sell-side indicator, which gauges strategists' sort of asset allocation views, and they recorded a shift in equity sentiment for the first time since October. Could that be like potential canary in the coal mine, especially in the thick of earnings season?
I think so. That they do a wonderful job with that indicator. And where we're trying to be very timely and very high frequency with our own indicators. I mentioned chain reactions. I think one of our issues that we're taking with the broader market narrative is there are these very ambiguous long and variable lags impacting the market. And then you have these knee-jerk reactions between soft and hard landing, depending on different monthly economic data reads or comments from the Fed. So to us, our set of indicators is thinking about those chain reactions. And I would say there's four main links in that chain of these rates transmitting into the economy. So the first link in the chain is monetary conditions. We already said they're historically very restrictive right now in nominal and real terms. That's feeding into a lower willingness and ability to provide loans. So you're having this contraction in credit conditions, which then hurts corporations. And if corporations continue to hurt, and if they can't keep up with this very high bar of earnings expectations through 2024, then unfortunately what happens is payrolls will get cut, job numbers go down, unemployment can go up, and wages can get cut. And that hits the last link of the chain. Very unfortunately is the consumer, the backbone of US GDP. If 2/3 of US GDP is the consumer, and they're the last link in that chain, there could be a long lag. And that will feed right back to corporations. That will hurt their top line revenue. That can be that recessionary death spiral, which needs those emergency Fed cuts. Or the other outcome, again, it's soft landing. All this kind of happens, but nothing matters. And the market's up 26% again this year. But the point for us is, as investors, don't take an extreme view on either side. The luxury we have is you have indicators and you have data for every link of that chain. And that's what we're being very vigilant and watching. And that's what's going to inform us. That's how we calibrate model risk up and down throughout our portfolios this year.
As you mentioned, there are two very different potential scenarios that could play out. Appreciate you breaking down your insights for us. Adam Hetts, Janus Henderson Investors Global Head of Multi-Asset. Thank you so much.